Thank you, Adina and David. I'm so excited that you were talking about smart regulation, because up next we have a fantastic discussion with Acting Undersecretary for Terrorism and Financial Intelligence, Brad Smith, followed by a panel discussion on topics related to illicit finance and regulation. I'm pleased to introduce our distinguished guest, Brad Smith, Acting Undersecretary for Terrorism and Financial Intelligence at the U.S. Department of the Treasury, who will discuss Treasury's recent reforms to U.S. anti-money laundering and countering the financing of terrorism, regulations and efforts to combat corruption, financial crime, and illicit finance. Prior to assuming the role of Acting Undersecretary, Brad served as Director of Treasury's OFAC, the Office of Foreign Assets Control, and also had a distinguished career in the federal government, serving in roles within Treasury, the White House National Security Council, and Department of Justice. Please join me in welcoming Acting Undersecretary Smith. Sir, welcome to the Transatlantic Forum, and please take it away.
Thank you so much, Ken. It was great to see you all, and I'm so sorry I have to join virtually. I wish I could be up in New York in person. I got some travel commitments that keep me here. Now, I have to confess at the outset that I think I am in many ways just a poor warm-up act for people that are coming after me. I know you have a panel with Jen Fowler and Chandana, among others, coming up. In addition, I think Matt Axelrod, Andrea Gacki, and David Reed will be on the subsequent panel, and those are real experts, and I wish I could hear them speak, because many of the things I'm going to touch on lightly, they understand and execute with such depth and sophistication that it is just an incredible opportunity to hear from them. I am also profoundly grateful for the opportunity to talk with all of you, because we at Treasury, and I think throughout the U.S. government, really value the opportunity to engage with thought leaders, with business leaders, with people around the globe on our important and sometimes complex authorities. Now, Kim referenced some of our regulatory actions, and I think that is an important point to focus on. But if I were to step back before turning to some of the specifics, I would just offer an observation that I think over the last year, but really over the last few years, we at Treasury, operating in the space focused on national security issues, as well as regulatory reform, have really tried to take what I would call a clear-eyed but humble approach to some of our obligations. We are acutely aware that we are the largest economy in the world and that we are the steward of the US dollar, one of, if not the major reserve currencies around the world. We know that with that responsibility and that power comes an obligation to understand how the actions we take on a global scale impact not only foreign adversaries, but also those in the private sector and allied nations. Over this past year, from what I would describe a perspective of humility and awareness, we have tried to focus a bit inward on how we operate and implement some of these authorities. We know, and we have often heard, concern from some of the private sector, as well as some of our allies, that perhaps sometimes we project and push for changes and behavioral adjustments without fully recognizing some of our own challenges and deficiencies. And we, in two significant ways, just in August, finalized regulatory reforms that we think will help the US government better address an issue that we confront globally: corruption. One of the first things we did in this past August is finalize through FinCEN a rule that targets residential real estate transactions. Now, in a lot of ways, this is common sense. We know, if you look in the newspaper, if you look at court challenges and prosecutions around the world, that sometimes nefarious actors invest and dump their funds in real estate. You've heard about Russian oligarchs. We can all think about narcotics traffickers. We know that sometimes transactions of illicit nature are hidden in what we call traditionally real property. And so this past August, FinCEN led an effort to update some of the US regulations in this space to essentially require that high-risk, non-finance transactions now have to report information about sales that occur to legal entities or trusts. Now, in a lot of ways, this is common sense. If you have a large cash transaction or something that doesn't run through the normal banking sector, it's justifiable to be a little bit suspicious. And so hopefully now with some of our regulatory reforms, we'll have a better understanding as to who's behind some of those trusts and legal entities that may be purchasing property. That's not to suggest all are improper or that all are problematic, but it's reasonable for us to ask those questions to have a better understanding as to what's occurring and why. One thing I'd offer, though, in looking at that residential real estate rule is to appreciate how nuanced it is. We recognize that sometimes U.S. regulations and activities that we may require others to undertake are burdensome. And that rule is fairly specific. It's not demanding every single real estate transaction be reported. It's not saying that everybody on the ground has to file a new report. It's really targeted at specific professionals in the industry who are involved in a subset of, if we look at it just from a common sense perspective, somewhat suspicious transactions. You know, it's in that same space that in August, FinCEN also finalized another rule. This one focused on investment advisors. Now, investment advisors also addresses what I think we can all recognize as a fairly common sense approach. If you open the newspaper, if you look around the world, if you engage with certain businesses, we know that we are obviously in a multinational global economy. And sometimes, for better or worse, adversaries will use our global economy and the opportunity to invest in U.S. industries to perhaps gain information or intelligence that could be used against us or be used against our businesses. And so, last August, FinCEN finalized a second rule that aims to bring the U.S. system and our AML obligations up to international standards. And it essentially requires that a subset of investment advisors now comply, as some of their colleagues in the industry already do, with anti-money laundering obligations, as well as filing suspicious activity reports with FinCEN. This too, like the residential real estate rule, is fairly targeted. It applies and has certain exemptions in place to make sure it's measured and really getting after the activity that causes us the greatest concern. It reflects what I think is an important effort by the U.S. government to respond to industry's concerns while also addressing important national security priorities. It's in that same spirit that we at Treasury, largely through our colleagues at FinCEN, continue to undertake efforts designed to implement the Corporate Transparency Act. We have out in place, of course, our beneficial ownership obligation, but in addition to that, we are now processing and responding to comments that we've received from industry about updating what we call the program rule, essentially the regulations that obligate compliance programs in the AML and CFT space. That process is ongoing, and we are very grateful for some of the thoughtful comments we've received from industry about both modernizing our obligations under the regulations while also finding a way to ensure that the burden is proportional to what we're trying to achieve. And that includes emphasizing a risk-based approach, which we know industry has prioritized for years, and which we hope, working with them and ingesting their comments, we can find a way to ensure we are all doing successfully. Now, AML and CFT are, of course, extraordinarily important to Treasury, and they're very, very, very significant in the United States and for a number of businesses in our country. And they reflect, really symbolically, I think, an effort for us to ensure that our domestic system is protected and fulfilling obligations that we often ask many of our allied and friendly countries around the world, as well as adversaries, to implement. But we've also made efforts, I think, in this space from the sanctions perspective. Sanctions are an area where we hear quite often feedback from global partners and from industry that too often the United States may act unilaterally or without a full appreciation for the impact that our actions may have on industry. Really, I think since the time I've been at Treasury, but certainly over the last few years, we've made a concerted effort to internalize and respond to that feedback and those criticisms. And you can only look around the world and see on a daily basis some of the global conflicts that we're confronting that have forced us to really think about those issues as we try to take on international challenges. Now, we have any number of sanctions programs, depending on how you count, upwards of 30 or 40. But without a doubt, two areas over the last few years have been a huge focus: Russia and Ukraine and that tragic conflict, as well as the Middle East. Both of those areas are hot conflicts in which sadly almost every day lives are being lost. The US government has deployed a variety of sanctions authorities to try to disrupt and undermine the flow of money and goods that support those conflicts and undermine peace in those respective regions. But we haven't done that unilaterally. One of the things really we have done over the last couple years, but particularly in the Russia space, has been trying to work with our EU, UK, G20, and global allies to ensure the actions we take make sense, don't unnecessarily harm allies, and are effective without overdoing and undermining our collective economies. That has required us, and indeed we have on a number of occasions, coordinated with any number of countries on taking actions on the front end. You can look at any number of rollouts that we have done with the UK, the EU, Canada, and other significant allies around the world in the Russia space. But it's not just the announcements of a prohibition, as important as those may be, that have been a focus over the last few years. More importantly, particularly for industry, which so often is on the ground implementing these prohibitions, we have worked with our allies to try to refine our guidance to ensure there's consistent messaging and to effectively minimize burdens on companies and private actors that may be in multiple countries. Now, it's imperfect. We haven't gotten a final solution that we would hold up and say is a model, but we are trying. And we have made significant progress, we think, in mitigating some of the unintended consequences that may have materialized in past actions, while also ensuring our actions are effective. And indeed, although it's always evolving, and when we are facing adversaries who are determined to kill other people, they are going to take everything they can and move as far and aggressively as possible. Nonetheless, we think we've made significant progress. Russia's economy has moved from a domestic matter to a wartime footing. We have frustrated their ability to engage through the Western financial system. And although goods continue to flow, we know, and Russia would admit, we have disrupted a number of their transactions, and we continue to look for ways to undermine their war machine. We're doing that collectively, because with the same humility that requires us to adjust our internal regulations and ensure that our domestic systems meet the international standards that we would ask others to achieve, we know that the United States, for all its economic power and the significance of the US dollar, cannot effectively act alone when taking on challenging and sophisticated adversaries. And that is why we are profoundly grateful for the efforts that we have been able to undertake jointly with the UK, with the EU, Canada, Australia, and so many others over this past year. And we hope, well, I don't know if we necessarily hope, because truthfully, we wish these conflicts would end. But if they aren't going to end, we're very hopeful that we can build upon the foundation we have laid for a broader, more multilateral action going forward to ensure we are as effective as possible so that we can, to the best of our ability, shorten these conflicts and bring about a peaceful resolution. So with all that, I will close just with the point I began with, which is that we are so humbled and honored to be able to talk to you all, that we treasure the opportunity to engage with industry and thought leaders throughout the world. We look forward to your feedback. And I wish I could be with you all today, but I'm so excited to know that you're going to be hearing from some of the leading experts in our government, with Chandana and Jen Fowler in a few minutes, and with Andrea and Matt Axelrod, and one of our closest allies in David Reed in a few moments. They are all wonderful, thoughtful, important people, just as the work you do on a daily basis is so significant for our broader effort to protect the global financial system. So with that, Kim, I'll just offer again my thanks, express my hope that we can all see each other in person soon, and my deep appreciation for everything that you all do each day to better collectively the values embodied in the Western world.
Thank you so much, Brad. And I know we have to leave for your next engagement. We really appreciate that you were able to take the time with us today. And we are going to continue the conversation with my former Treasury colleagues and friends. So please welcome to the stage Chandana Ravinadrath, Head of Strategic Illicit Finance Initiatives and Counselor to the Undersecretary for Terrorism and Financial Intelligence at the U.S. Department of the Treasury, Dan Tannebaum, Partner and Global Anti-Financial Crime Practice Leader at Oliver Wyman, and also an Atlantic Council Non-Resident Senior Fellow, and Jen Fowler, member of the Secretariat of the Financial Stability Board, who will be joining us virtually from Switzerland. Great. Well, thank you everyone for being with us today. I'm going to jump right into it. I mean, Chandana, this morning we've heard from NASDAQ CEO Adena Friedman and also Acting Undersecretary Smith about the need for curbing illicit finance and smart regulation. And from your perspective as head of strategic illicit finance initiatives at Treasury, I mean, what are some of the biggest challenges or threats illicit finance poses to the financial system right now? And if you could also elaborate on just how does Treasury actually determine that risk?
Yeah, thank you, Kim, and thank you, everyone. It's a real pleasure to be here and with this very esteemed panel as well. As we heard from Acting Undersecretary Smith and Adena, really what is old is new sometimes, and what is new is old, in that we're still seeing a lot of the threats focused on fraud, drug trafficking, cybercrime, corruption, transnational criminal organizations, and professional money laundering. So it's really about how we are helping the private sector, and the private sector is helping us track this activity. And so the threats, change day to day, but we also have seen this sort of play out in a number of decades as well. And as we've seen both in the Russia context and other huge national security areas that we're focused on, is that bad actors rely on illicit finance in order to fund, whether it's Russia's illegal war on Ukraine, whether it's terrorist attacks that are occurring all over the world. They really rely on illicit finance and all these. And as Acting Undersecretary Smith said, with the US being the largest economy in the world, we know that we really shoulder a lot of the responsibility in making sure that we are protecting not only the US, but also the international financial sector. So with that sort of on how we assess the risk, it's really, Adena mentioned the feedback loop. We really rely on the private sector, both in the reporting obligations that you have with our colleagues at FinCEN, who do the threat analysis and the trend analyses, but also in conversations like this. Private sector is on the front lines, and they're seeing, I think, Kim, you coined the term tip of the spear, really focused on what is happening day to day and helping policymakers. So the Treasury Department every 2 years publishes a money laundering, terrorist financing, and proliferation financing risk assessment, where we look at all available data, whether it's on the intelligence side, financial intelligence, and the trends we are seeing, talking to the private sector as well. And every time we publish those, we also go on what Treasury staff call roadshows to both highlight those risks, but then get feedback. So almost as soon as we publish one set of risk assessments, we are starting on the next, just to make sure that we're incorporating that feedback. So it really is the feedback that we rely on the most in assessing the risks.
And that's a great segue to Dan. I mean, you've been on both sides of this issue, having worked at Treasury for a long time, and as well as in the private sector. So I was hoping that you could discuss why is it so important for financial institutions to have robust compliance programs, and then how would you assess the level of mutual understanding and cooperation between the policymakers in DC, the examiners on the ground, financial institutions, and sharing the information and on compliance?
No, it's a great question. It's how I spend my days advising firms, trying to navigate the changing rules and the threat landscape that everyone up here and previously have spoken of. I think it's important to also note these really shouldn't be known as compliance functions, because when you talk about complying, it has a different set of expectations than actually managing risk. And I do think that point on the why has been lost somewhat along the way. Compliance programs banks are spending upwards of billions of dollars a year to manage financial crime risk in the money laundering, sanctions, anti-bribery, and fraud space. But a lot of the activities that have been done have been built up over time. They don't actually identify risk universally. There's been a reluctance on the part of some firms to actually take a risk-based approach, despite the fact that's been the guidance from the government going back decades now. So I do see that loss on the why, where activities are being done at a high cost that don't actually move the needle in identifying suspicious activity and bad actors and really keeping bad money out of the ecosystem. I would say there's somewhat of a disconnect between what I see from a policy-making standpoint, which are pushing the right agendas, topics like effectiveness, like actually operationalizing a risk-based approach, and how they manifest themselves on the ground in financial institutions. I think some of that comes with a high-level set of expectations from a supervisory standpoint, with a mechanism that's largely built off of examiners that see something that looks good in one firm and try and translate it into the next, even if it's not codified in regulation. So, I mean, probably the best example I can give to what I see as one of the issues in the landscape today is most banks take the absence of supervisory criticism as a proxy for programmatic effectiveness. And almost universally, those are the firms who end up being in trouble next and taking that position.
So don't stop paying attention to these issues. Jen, I did want to turn it to you. Thank you for joining us all the way from Switzerland. And so I'm not sure how much the folks in this room really know what the Financial Stability Board does. And it has a really unique role within the global financial sector in coordinating financial authorities as well as standard-setting bodies with the goal of enhancing cross-border payments. So I was wondering if you could tell us a little bit about FSB and specifically kind of what are the priorities that you have in this area?
Sure, thank you so much, Ken, and thank you for allowing me to join virtually. I'm so happy to be here and be part of this panel. In 2020, the G20 asked the FSB to develop a roadmap for enhancing cross-border payments. And so we coordinate the implementation of that roadmap with our partners, the CPMI, standard-setting bodies, all the relevant international organizations. And the roadmap is really focused on addressing what we all know are major challenges in cross-border payments, including high costs, low speed, insufficient access, and of course the lack of transparency around fees and sort of disclosure issues. So those are the key challenges we're trying to address with our roadmap. I think the roadmap was designed to be flexible over time, and we have a lot of work underway to implement it. But I think our understanding of the issues that are creating those challenges is pretty stable. And I would say that one of the major issues that we hear about the most is really AML/CFT compliance and sanctions compliance as sort of one of the frictions that creates some of the issues that I just mentioned. And now I really hesitate to use the word friction because I think it has a negative connotation. And we all know that friction is necessary in cross-border payments to be able to keep those payments safe, and that's also one of our goals. I think what we are trying to achieve with the roadmap is to improve cross-border payments, but also keep them safe. So figure out which are the frictions that are necessary to enact, really robust AML/CFT compliance that's effective, and which of the frictions are not necessary and things that are basically slowing down payments without, achieving those national security and safety objectives. So when we look at the frictions and the things that we are working on addressing, what we see is that a lot of times it's the legal and regulatory and supervisory frameworks or the data standards that if they were better aligned, we think we could achieve both. We could achieve faster payments that are lower cost, and we could also, achieve safer payments that are basically or have AML/CFT controls that are better implemented because we've done that alignment and done that work. So I think some of the examples of work that's related here that's ongoing, of course, is the work of the FATF, which I won't get into too much detail, but I think many people are aware that FATF is looking at recommendation 16 and what data needs to be part of the payment chain, and I think that's a really important cornerstone issue. At the FSB, we've done 2 really important pieces of work this year. We've published proposed recommendations on data frameworks and how data frameworks interact with AML, CFT, and other legal and regulatory frameworks. And we've also published proposed recommendations on how to level the playing field between banks and non-bank payment service providers. And I think both of these just go to this goal of trying to better align across jurisdictions.
And thanks, Jen. And I want to pick up on your point on aligning across jurisdictions. This jurisdictional arbitrage is often raised as a big concern, especially by policymakers as well as regulators. And as illicit actors can kind of take advantage of different discrepancies between the different financial rules and regulations, depending on which jurisdiction they're in and where they want to move money. So, from your perspectives, I mean, how big of a challenge is jurisdictional arbitrage? And, what are some of the efforts that are underway to address some of these gaps? I mean, Jen spoke to some of them, but, Chandana, maybe if I could pitch it over to you first.
Sure. I think we've seen a lot of it, and I think ultimately all of us know that the weakest link, no matter what it is, will always be where criminals and illicit actors look to exploit. So the jurisdictional arbitrage is a big focus of a lot of international bodies and the US government as well. And Jen mentioned the Financial Action Task Force, which is the international standard-setting body on anti-money laundering and countering the financing of terrorism. And part of the role of the FATF, or Financial Action Task Force, is to make sure that countries are having sort of a leveling the playing field, as Jen mentioned, and making sure that we are holding all countries to the same standard. And within that, I mean, including the United States, a lot of the regulations that you heard Acting Under Secretary Smith discuss were those deficiencies that were identified by the Financial Action Task Force in our 2016 Mutual Evaluation Report. And that is a vehicle in which countries are publicly identified as needing improvements, whether they're major improvements or if they're minor improvements. So that's a huge focus of the FATF and the U.S. government, and it's vitally important to sort of highlight that. And as Dan mentioned in his piece as well, is making sure that the financial sector sees that as well, so they understand the risks in engaging, but also understand how they can help bridge some of those deficiencies and risks. So it is an issue, but it's great that bodies such as the FSB and FATF are really focused on that.
And Dan, I mean, what about from your perspective in the private sector?
I mean, I'll look at it from the perspective of what we've seen with the Russia sanctions over the last 2 years, which is probably one of the better examples of a multilateral response. Now, even despite that, there's slight discrepancies in the implementation in the US, EU, and UK, but directionally those regimes are the same. Where there are those inconsistencies, what I've found is the governments are all quite eager to try and help their global institutions and constituencies find a way to implement these regulations effectively. I think for most of the global firms that are out there, they really are looking for that common thread, and especially on AML regulations, there is quite a lot of commonality, even if the regulations are written in different parlance. Looking at know your customer standards, for instance, when you depersonalize the regulation, the information that you're trying to capture from your customers, the data that evidences it, are largely similar jurisdiction to jurisdiction, but that can be an activity unto itself to try and take that step back view and really look for what is the most common global approach.
And, another kind of big point on this that Adina mentioned in the session before us was information sharing, right? And the data that either can or cannot move across borders and between different financial institutions. And so, Jen, the evolution of the threat landscape, it's not unique to the United States. I mean, as Dan mentioned, the case with Russia in particular was a great example of that. And then so, as U.S. allies and partners, we often face very similar challenges when it comes to payment services. So I was wondering if you could talk a little bit about some of the data sharing issues that you're seeing across jurisdictions, but also especially as it relates with cross-border payments.
Right. I mean, this won't be a news to anyone here that when we talk about data frameworks at the FSB, we're talking about just an incredible number of laws, regulations, rules that have to do with the management of data, data privacy and protection, which sometimes align with AML CFT requirements that are reliant on data, and sometimes they are in conflict. Those data privacy and protection laws have an important public policy objective, but so do AML CFT laws and regulations and controls. So what we've been looking at are what are the ways in which we can develop tools that allow for information sharing, that allow for robust AML/CFT compliance in a way that is within the context of data privacy and protection rules. We've done a lot of work on this. We've published some recommendations this summer, as I mentioned, for public consultation. We're working on finalizing those recommendations. But a couple of things that we're recommending are, first and foremost, are to create a forum, a body where all of these different stakeholders, the data privacy and protection communities, and also the AML/CFT and sanctions communities can come together with payment experts to really talk about these issues and work on solutions. That's really a cornerstone of what we're proposing. And I will say, I think one of the most important things we've done this year is to really forge a lot of relationships with those communities, and we're continuing to do that so that we can work together on finding solutions.
Thank you, Jen. Yeah, I think it's a fantastic idea. I hope everybody can consider it. Chandana, I did want to turn back to some of the points that Undersecretary Smith made, and that you also referenced. Just the fact that Treasury recently finalized several different regulatory reforms, and this is a huge undertaking. So also congratulations. This is something I started working on back in 2014 when we first met. So I was wondering if you could discuss some of, especially the new reporting requirements, because that also is additional data that will be entered into the system. It relates to some of the data sharing challenges. But I was wondering if you could discuss with us, like, why were these regulatory reforms so important, and especially why were they important now?
Yeah. Thank you so much. And I think one, just to sort of bring back what we've heard other speakers say, like Adina was saying, what is a smart regulation, and how do we make regulations smarter? And really, I think when you look at both of these rules, the residential real estate rule and investment advisor, they weren't just, we woke up a year ago and we're like, let's do this, it's gonna be so fun. But really, we looked at data that we've been collecting for years. So in the example of the residential real estate, FinCEN had been collecting information under our geographic targeting order, which is a temporary record reporting requirement since, I believe, 2016. So really collecting that information, giving that information to law enforcement, allowing law enforcement to use that information as lead for various prosecutions, investigations. And we, in fact, heard from law enforcement how helpful that information was. And really an exemplification of that is during the proposed rulemaking process, we saw comment letters from law enforcement saying how important this regulation was for their investigatory, what they need to do to investigate. And we heard from a lot of transparency groups and also, honestly, private sector folks that this was really, really important in order to help level the playing field and catch illicit actors. So with the residential real estate rule, quite frankly, it's been almost a decade that we have been collecting information and have decided to, under FinCEN's authorities, to promulgate permanent regulations. And really, as Undersecretary Smith mentioned, it's really on a very nuanced and specific area. So it's really those non-financed residential real estate. We're not asking for every single residential transaction, understanding that a lot of American families and businesses use finance, like the mortgage system and in the banking sector. So really those non-financed and mostly cash transaction where we've seen that illicit activity. And similarly with investment advisors, largely previous to us finalizing that rule, it was really a patchwork regulation. So some investment advisors were covered based on where they sat, whether it was in a bank or other covered financial institutions, and others were not. And we had seen, it was our third attempt to finalize, so we had received comments and information since I believe the first one was in 2003, over sort of the last several decades on that, and really, again, nuancing it and making sure that it was connecting sort of the patchwork and making it a level playing field across the entire sector. So really taking the time to make sure that we got it right.
And then I'm just curious, just for the extent that you can share, like in any of the feedback that you did receive, I mean, has there been any concern flagged about these types of reforms like leading to de-risking where, maybe different customers or clients are no longer being banked?
So not in any of the comment letters that I can recall off the top of my head, but it is something that we are constantly concerned with. I think some of Dan's comments also mention, sometimes financial institutions or covered sectors will just be like, we don't want to deal with that at all. So Under the Anti-Money Laundering Act that was bipartisan passage in 2020, Congress did require us to do a number of studies, including a de-risking report. And basically all of our conversations at Treasury when we're talking about this is how we make sure that anything we are doing, whether it's in the sanctions space, whether it's in the regulatory reform, or any other, is not causing financial institutions to just walk away. And again, that's really that nuanced approach between our risk assessments as well as the constant feedback loop. And maybe one other regulation that I know is near and dear to a lot of people's hearts, but it doesn't get the same attention, is the program rule. And that we just we just closed the comment period on that earlier this month. But that gets to exactly the points that Dan was making, is to how do we make our system more risk-based and effective, and make sure that we are collecting the information we need, but not overburdening financial institutions, and making examinations effective as well.
Yeah, and Dan, I kind of want to go back to some of the points that you raised previously. I mean, with these, especially these new reforms now, I mean, have you seen a change recently in how different financial institutions are starting to manage risk as a result of these?
I think there's, to everything that Chandana just said, there's a concern of this is new or more.
Yeah.
And again, all of these evolutions should force firms to take a step back and really understand, are the activities that they're doing today under the banner of the Bank Secrecy Act, of OFAC, actually moving the needle? Are they appropriate? I mean, I still have clients having issues laundering bulk cash in 2023. So we talk about complex schemes, but these are some very basic issues that have been at the heart of money laundering cases for decades. Not to say I wish I had more complex cases to deal with, but realistically speaking, there's still some baseline issues that firms have lost sight of along the way. And there's been a whole series of enforcement actions that have been wonderfully helpful to some firms to understand what not to do. Those reminders are important, but I think firms are afraid of anything more than what we're already doing. Export controls has come up during the IMF World Bank meetings last year. Yeah. Banks were convened to talk about expectations on diligence in the export control space, not to deputize them by BIS, but be on the lookout for goods that would be on the wrong side of the dual use restrictions. None of them were equipped for that, realistically. They could barely handle trade-based money laundering in some instances, and now there's an expanded opportunity. And it is the right choke point to leverage banks to identify these transactions. So I think firms are afraid of having more dumped on them. But again, it goes back to how can they run these programs as efficiently as possible, not efficiently in the cost sense, but efficiently in the sense that the activities they're doing are fruitful in the form of identifying real risk and ceasing the activities that don't find things.
You know what? So we are at time. So I think we are going to end on that note, because right after this, we'll be talking to Commerce about export controls. But thank you so much for joining us today here, and Jen, thanks for joining us in Switzerland. I think she's already left. Thank you. Really appreciate your time today.
Thank you.